Hello everyone, welcome to our part one of our discussion of chapter 11, specifically retirement and other tax deferred plans. This is kind of a unique area of the tax law, and so it gets its own chapter because there's so many different variances or views on this. So let's dive in here and see what we might to learn about these specific areas of the tax law. So when we refer to retirement plans, we're talking about those that have been specifically designed in the tax code. And the idea is Congress has determined that these should be tax favored, meaning we want to encourage people to save for retirement or for education. And so to do that, they have deferred the tax on the earnings specifically, and most of the time the taxation is not eliminated. So it's not a tax-free account or plan. It is a tax deferment, and the idea is that you defer taxes and pay them as late as possible, and that when you're retired, you're in a lower tax bracket. Remember, we learned that the more income you make, the higher the tax rate is. So when you're not working, you're retired, and you pull money out of these accounts, the idea would be you would be in a lower tax bracket, meaning you would be paying at a lower rate, and therefore it would be advantageous for you to pay the taxes then instead of now, sort of scenario. Okay, so we have employer-sponsored plans. That means that the place where you work, your employer is going to do a lot of the record keeping and make sure that it happens correctly. They have certain responsibilities for those, and then you have, if that's not available, or even in addition to that, in certain cases, you can have an individual-based plan that you've heard of probably in terms of IRA. Those are what we would refer to as an individual-based plan. So they do not have to be associated with an employer per se. So some terminology that is going to come up here and there. Find it on your textbook. Annuity, and typically a regular payment, monthly or annual. It's a steady stream of payments. Beneficiaries, who gets it something after you pass away, you leave it to. Contributions is what you put into a plan. Distribution is what you take out of a plan. Think of it as a bank account type of scenario with restrictions, meaning unlike your regular bank account, you can go and get the money anytime, you can put money in anytime. There are restrictions to these accounts. And I want you to understand when you an IRA account or a 401k or any of the plans, that does not refer to the actual investments that the plan has. That's just an account with a particular financial institution with these restrictions. Then the decision to what to invest that money in is a separate decision. And that is what that could be done in many different ways, but that's an investment issue, not a tax issue. So we won't focus on what you actually invest in. That would be a different scenario. What we're talking about is making sure that we follow the restrictions according to the law, so that we get the tax advantages, or at least we know what the tax results are going to be. All right, so trustee, that last one there, is the person or the financial institution. It's not going to be a person that makes sure that the restrictions are followed and sets up the restrictions. In fact, we sign an agreement with the trustee to those restrictions. So the general idea is if you put money in that is untaxed, meaning you got a deduction for it now, okay, then you're going to be taxed on it when it's distributed, when you take it out. So you deferred it, but you don't get a freebie, okay? Previously taxed contributions, if you put money in and you don't get a deduction now, meaning it doesn't reduce your taxes now, then when you pull it out, most of the time it's not going to be taxed at distribution. All right? For employer contributions, as long as there's the plan set up correctly, there's a tax deduction for making contributions on behalf of your employees. So it's important to know how the money went in, what the status was when it went in, so that you know what it was, what the tax situation is when it comes out. All right, and you need to know what type of account, so you know whether or not it's deductible now or not. Some examples of employer-sponsored plans. 401k is probably the most common. 403b is for nonprofits, schools and things like that. It has very much the same types of rules as 401k. KEO plans, SEP plans, simple plans are for small employers and self-employed individuals, that sort of situations. So they have some simplified rules and things of that nature. Okay, so what they all have in common, as long as they are qualified. Now we are really only talking about what is referred to as a qualified plan. All of these, if set up correctly, are qualified plans. There is a whole set of plans that are non-qualified, and we're not going to get into that. Those are usually have narrowly set up and things like that. You're not going to run into them very often, and they usually favor just a few people rather than broadly like these plans are. So these are all qualified plans, assuming that the rules are followed. So employer gets the deduction for the contribution now, even though they are not compensation to the employee. So I put money in to my employee's account for a 401k. They do not have income. I get a deduction, but they do not have income. See, so I get a tax benefit, and they don't have income. That's the point. The earnings inside the plan are not taxed as they are earned. Okay, so you're postponing any tax on those earnings, and you don't have to worry about taxation on any of the plan assets or what the investments in that plan until you start withdrawing them, and of course there are restrictions on that. So that's what a employer-sponsored qualified plan does. They all have that kind of in common, that employers get the immediate deduction and so forth. Now, two types of broad types of plans. The defined benefit plans have pretty much gone away. That's the typical pension from the old days, where the amount that you're going to get out of your plan when you retire is set, some kind of formula based on your earnings. And so the employer has a responsibility to make sure that there's enough in the account to pay that set amount. That was a lot of responsibility for the employer, so most employers have chosen to go with a defined contribution plan. It says, the employer says, I will promise to put so much in, I'm not going to promise you how much you're going to get when you retire, what you can take out. So that will depend on lots of factors, how well the stock market does, whatever your investments do. So the defined contribution, all I promise as an employer is that the amount going in is going to be set usually a percentage of the employee's income. Okay, so that's the difference between those two types of plans. These have become very rare. These are pretty much 90% of the plans these days. So to be qualified, some of the rules to make sure that we qualify and we get all these tax benefits. They have to be non-discriminatory. That means that they cannot have a higher rate of benefit for highly compensated employees as opposed to everybody else. And there's rules about which is highly compensated employees, owners, that sort of thing. Those that are making the most, big bucks in the company. If you can't give them a higher percentage of their income into the plan than someone at the making $20,000, so that would be discriminatory. As long as everybody is getting the same percentage of their income, even though the amount that's going in is different, as long as it's the same percentage of their income, then you're not discriminating typically. They have to vest. Vesting means you're entitled, if you quit the company, to that money. So your contributions, any money that you put into a plan, 401k, doesn't matter what the type of plan is, as an employee, the employee puts money in, it has to be vested, meaning they cannot lose that by quitting their employer and going somewhere else. However, you can establish vesting schedules for the amount that you match. So you've heard of matching contributions by employers. That you can have vesting, but you can't make them wait 10 years to vest. It has to be according to the rules of vesting. There's a minimum vesting rules that you have to abide by. All right. Contributory refers to the amount of money whether the employee can put money in. There are a couple of plans that don't allow the employee to put money into it. So there's no employee contribution and employer contribution. It is only employer contribution. So some other limits you have to have in terms of how much you put into the plan. There's limits for a defined contribution plan and a defined benefit based on how much benefit is provided later. So if you go outside of any of these, then you're risking that you are a non-qualified plan, and therefore you can't take the deduction. You may have your highly compensated employees that have to report income. There are various bad things that can happen if you don't meet these rules. So, some of the rules for 401ks, they must meet discrimination rules. So you have to show that you covered most of your employees, that you have not picked and chosen which ones you're going to do, and that you haven't given more benefit to the higher paid employees. The maximums here, 19,000 unless you're over 50, and there's an additional 6,000. That's kind of a theme that they allow those over 50 to contribute more because the idea is they're catching up and they didn't do it earlier in their lives. KEO plans have limits we heard about earlier, generally as other qualified plans for self-employed folks. You also have some non-discrimination rules there. Then there are two simplified plans. The SEP plan, the employer actually just creates an IRA and contributes. This one is, a SEP plan is non-contributory, meaning employees do not make a contribution. Only the employer, all right, contributes to the SEP plan. It has to cover just about everybody, so it really is not subject. It doesn't have to be tested for non-discrimination. because by its design, it can't discriminate. It has to provide the same percentage for everyone, and for everyone that makes as little as $500 in a year. So it's a you don't have much restrictions. You have a lot of rules that way, and you don't have any restrictions on the people that you can cover. All right, a simple plan. That's the terminology. It's supposed to be simplified. You can do it either as a simple IRA or a simple 401k. Notice the limits are lower than a SEP plan. We've got an extra for if you're 50, okay? But you have employer and employee contributions. Employer must match, okay, up to 3%, or just put in 2% for everybody. They have their choice, okay? By having that requirement, if you meet that requirement, then you don't have to be worried about your non-discrimination testing per se. So by its design, the simple plan is non-discriminatory and is qualified. So it was a way that companies could create a plan without having to go through a big process of getting a plan put together and the documents and all that kind of things. Both of these two that are on this slide can be done with very straightforward, simple paperwork, and working with the trustee, of course, because you can't, as an employer, hold the money yourself. It cannot go into the employer's bank account, and then it has to be held in trust for the sole benefit of the employees. That's what the trustee is about. They have to actually have the money so that if the employer went broke, the money would still be in the hands of the trustee. It would not suck the money out of these employees' accounts if the company went under. All right, that's where we'll pick up on individual plans in part 2.